Well, hello everyone. It's Ken Winans and Stephanie Larson from Winans Investments, and we hope that it's funny how we say Happy New Year, but we're already almost 6 weeks into this year. How the year has flown. As probably many of you in Northern California knew, we were dealing with some pretty serious rain issues up here. That fortunately it didn't affect our staff too much, but getting to work some days was problematic. But we just thought it'd be good to talk since you now all had your year-end reports, and we are able to shake off 2022 as a year that I think most of us like to forget on many things. But we wanted just to, one, tell you what we saw in the first part of this year, two, to talk about that, what we expect certainly for 2023 and how we're trying to play it. Let me start with, as you all know, we did not have the big bounce in December that we usually did last year.
Yeah.
That caused Stephanie and I to be somewhat concerned
Frustrated.
and frustrated and guarded on what and where we stocks would go into.
Especially since it carried into the new year,
Yeah,
at
absolutely.
least the start of January.
And it was very volatile in both directions. It was the highs and the lows. But what we do see happening right now is that there's, not to get too deep in the weeds, but there's a way to make money on stocks going down called shorting them. And I think that a lot of the bounce that we've seen in a lot of the really beaten up stocks through much of this year is people covering and taking profits in those shorts, realizing that although the Fed's going to keep raising rates, the market is certainly not going to just keep heading automatically straight down. I think time will tell whether these bounces really are new rallies in these stocks and they're going to pick up and go from there. The bottom line is patience is a very important key in this kind of market. I would say the number one thing I'd like for you to walk away with this video is to chase anything. I think you're going to ask for trouble. I was telling Stephanie, there's years in my career that I remember with painful lessons, and one of them was 1994. And it was a sideways, miserable year. It was plus and minus 8% through the entire year. And I found myself over trading and getting what term we call getting whipsawed. And I swore I'd never do that again. So when I'm in years like this, which I do think 2023 is not going to go down as a year much more than plus or minus single digits, but with a lot of volatility. So I think we want to be careful on that. And Stephanie, anything you want to add?
No, I'd say, we definitely took a conservative approach to this year. We put the hedges on early on. We didn't like the way that we didn't have the Santa Claus rally and it continued into January. So we definitely are more conservative, especially since the volatility is picked up. The economic data has been a little mixed. Really strong jobs report, which ironically is not good when it talks to in terms of the Fed. The Fed is still going to be raising rates. Powell's come out and said essentially that. Earnings season has been very volatile. Huge misses, huge wins, but huge misses. And if if a company missed, they got really punished into like the 20% range. You definitely, when you see the market kind of doing what it's doing, and we want to be active in it, but you're literally in the middle of earnings season. If you make a bad decision, you can get, really punished for it. So we're just trying to be a little conservative as we decide how we're going to position the portfolios this year and adjust the strategy moving forward. As now the 2023 is starting to shake out a little bit, I think we have a pretty good idea of what we want to do and where we're going to go with it. So that's interesting. I'd also say that officially, for those who ever go on Investopedia or something like that, if you look up the definition of stagflation, now that we have companies doing layoffs, and there were more announced today and it's not just tech. Obviously, the tech ones tend to be a little more vocal, so you'll see them in the headlines. But industrial names, retail, it's across the board. Now that we're starting to see a pullback in employment or layoffs, technically we're in the definition of stagflation, right?
Absolutely.
So
I would also add too that whether you're talking about stocks or real estate. Or even in commodities, bonds are a little different story just because of the certainty, at least the way we do bonds. But the point is that it's really not so much of buying a market or buying an industry. It is more you have to look for those names that have done well. A good case in point, retail. Clearly, some of the retailers that were struggling have figured out how to play the game. They have readjusted things. Others are in big trouble. You probably read about Bed Bath Beyond is close to bankruptcy. You're going to have shakeouts like this across every industry group, around the world. And then I think, as far as I've been asked a couple of times about foreign markets, well, take a good look at what's happening in China or India. India is having one of their massive conglomerates right now is blowing up, and it's a big part of their economy. So it's hard to find those places that you can call safe havens, so to speak. The U.S. is still by far one of the places that people want to come to. They want to bring their money here. And obviously the dollar had a huge rally over the last 2 weeks. So there's things like that. We want to keep this video kind of short because we think we'll have more to talk about in the next 2 to 3 weeks. I did want to bring up, many of you asked when I was going to do my next public speaking. I'm actually speaking to the New York chapter of the American Association of Individual Investors. Amy sent you an email on it. It is a webinar. It will also be recorded. But I'm going to talk about financial history quite a bit. It's going to be not so much driven on any investment strategy, but just, again, to take a big step back and look at why the way we do things using financial history is so important. And then we want to, every now and then we need to do a victory lap, and you're clients, and we appreciate the support you give us. Morningstar just reaffirmed our top rankings in most of our strategies, and we did find out that we finished out the year in the upper 1% of stock market performance. So for our little firm to be beating the stuffing out of some of these big giants, really giving us a sense of pride here, and we're very proud of what we accomplished. Again, you don't fall back on your laurels, you always look ahead, but it's important to know that at least we have a decent gauge of how to handle these kind of markets. I would just want to finish on a couple things. I know that the old adage, hope for the best, but also plan for the unexpected. I think that's the way you have to treat this. Stephanie's brought up, it was stagflation. Although I'd like to think inflation's going to dissipate, I know that it takes years and years and years to have this happen. It's going to vacillate. It's going to go up, pull back, go up, pull back. But it's very hard to get out of a system. It took us a very long time in the 70s to do that. And so the reason I'm bringing it up is that although we might see the Federal Reserve tapering the rate increases, the effects of inflation on investing are going to be very pronounced for years to come. And so again, the kind of companies that we buy will be different than you would have bought in the last 30 years. The activities in which we do, and we know it's very tough when you're, especially in a taxable portfolio, having to pick between tax bills and letting good gains go to heck because of a roller coaster. We're trying to keep that minimal, but we're not going back to the old world. I guess if that's one thing you're hearing us talk about. But I'm saving the best for last because I want Stephanie to tell you what we are very convinced on, and that's in the bond and preferred stock world.
Okay.
Yeah.
So last year, I actually had this conversation with several clients. They were surprised at how volatile the bond market was, and something I've written about in several of our commentaries is that if you look at bond price history, it actually moves quite a bit. Obviously, since we buy and hold, the price volatility is just uncomfortable. It's always about the quality of the credit. Do you have confidence in the company? Is it going to default? No. I mean, our default rate is extremely low. But to have a year like last year in the fixed income space is incredibly uncomfortable, especially since most clients that have, especially exclusively income portfolios, tend to be retired. So we would highly be suspect if we thought it would have back-to-back years like that again. What we've seen in January, even with the Fed, is that prices have started to come back. I think our composite was up 4.5% for January. They're just the income composite. So bond prices tend to lead equity. I'm not saying that if bond prices recover, then equities will immediately follow suit and everything's hunky-dory. But that's tend to be historically what you'll see with the bond pricing. So why that matters, the pricing is getting tighter. It means you're going to cough up a little bit of yield as we enter the market. Last year, I know that for some clients, it was very uncomfortable. If you had money on the sideline, and our advice was to invest it while you could get into a market like that with new money and buy really low, cheap priced bonds, right? That window's kind of shut. It doesn't mean that I still can't find good bonds, because I am. I can, but it's going to get a lot harder. You instead of buying and getting around the 8+% range for yield to maturity, now it's going to be in the 6 range, depending on how far you go out. We obviously are still trying to stay short. Anyone that sees me buying in their portfolios, you see that I'm buying actually very short paper, 1, 2, 3 year paper. I'm starting to go out a little bit. I do want to go a little farther out, because that means I'm going to get more yield. If you stay in the 1 to 2 year range, you're getting about 5%. So you have to go out a little farther now. But it's nice to see the market itself recovering on the bond side. I know it definitely makes the clients, all of our clients, more comfortable. They don't like to see that type of volatility. So the bond market, again, is usually extremely boring. You know, I've said this before, you don't walk into a party and go, hey, did you see the bond I just got? It was amazing. And it's just not something you talk about or brag about. It's usually just very benign.
Unless you're a Winans client, then you can brag about your bonds, okay?
True.
Well, please do.
We
Tell
do.
all your friends about them there.
We do. But this year, you know, I think it's going to be interesting, but I don't think we're going to have another year like we did last year. I'd be surprised if we actually had a meaningful pullback this year. I think it's going to continue to recover. So it just means that you have to put on your bond hat and really work hard and look for the quality bonds that you can. And we'll probably extend the maturities a little bit farther, because you will get more yield if you go out a little farther. So it's just one of those interesting times, and keeps you on your toes. It's never boring.
I would say this, just to reiterate what Stephanie said. Now, one of the ways we want to play this game is when you get to the point where the Fed is close to ceasing their interest rate rises and their monetary contraction, that's when you want to extend maturities, because that's when you think about the old days when people said, gee, remember you had those bonds or paid those high yields? Well, that's people locked them in at those high points. I do think we're closer to that than we realize.
Yeah.
And don't in the standard world, from day one with this company, the average maturity of a bond portfolio has been between 5 and 6 years. So what that means is that we will start at some point in the not distant future be buying 10-year bonds, 8 to 10-year bonds, and you will get good yields. But that's only as we get a clarity on what the Federal Reserve plans to do with interest rates.
Yeah.
And also, I would say we're also buying preferred stocks as well.
Yeah.
We're looking at dividends on these stocks, and remember, most of them have tax preferential treatment, where their dividends are taxed at capital gains rates, which is very low.
I've been buying them the last few weeks.
Yeah,
You'll see them enter your portfolio if you need space for it.
absolutely. And it's very typical to see as much, anywhere from 10 to 20% of a portfolio in preferred. So again, we're going to try to go back to normalizing our bond portfolio, our income portfolios, to be more of what we've seen in the past. And then, you know, it's early in the year, and there's going to be volatility. I know it's mind-blowing for people to have to deal with it. Feel free to call us. What I would say, for those of you who want to talk to us about strategy in your portfolio, let me leave you with this. What I've been generally recommending to people is that if I'm asked to bet, do I think that a bond portfolio that's yielding 6 to 7% on average, and the stock market averaging 6 to 7% over the next 36 months per year, I would bet on the bonds. So I'm telling clients who really don't want the volatility that they might want to think about changing their allocations. We're not ordering you to do it, but we're telling you that if the volatility is bothering you, really bothering you, then it's time to consider making an adjustment. And so just give us a call and let's talk about it.
I'd agree. And we've had several of them. And it's just that time. And I'll reiterate this one more time. The idea of risk is different for everybody. It's not age specific or anything like that. I actually have a relatively conservative portfolio for my age, and that's just because that's my personality. So, you know, really have a heart-to-heart with yourself and think about how last year made you feel, and even to the start of this year. And if you feel like you probably should be a little bit more conservative, a little more certainty, a little more capital preservation, then it's probably a good idea to change your allocation a little bit.
Absolutely. I forgot to bring up one last thing. I've been asked quite a bit about commodities. And one of the concerns we had was that in the commodity ETFs that we were using, a lot of them produced tax forms called K1s and K3s. And I be honest with you, I completely forgot what a K3 was because it had just been that long since I did any kind of foreign trading in commodities. But anyway, as much as I believe in commodities, I know that the tax bills or the K1s cause people a lot of problems. So Stephanie and I have just been a bit hesitant, but I will say, probably many of you noticed we've added gold to your portfolios. We're probably going to add silver. The things that do not spit K1s out, we will more than likely buy. But again, I still think commodities will have a nice era in this time of inflation.
And we're looking for alternatives.
And we are looking for alternatives, absolutely. So folks, we wanted just to say hello and give you 2 cents on what's going on here. And we look forward to hopefully seeing all of you at some point in time this year. We are going to have an investment conference. We're leaning toward first week of May, but it might be later. You will get a notice on that. It will be a combination of in our office and also a webinar. So we'll get back to you on that as well. So that might be a great time for us all to get together.
Great time to do some Q&A. I mean, I know clients, can feel free to email and call us at any time, but a lot of you guys have the same questions, and it'd be kind of nice. We've also been toying around with a segment to do maybe once a quarter called Ask Ken, where you can send any questions that you have, strategy, market, just whatever it happens to be. And Ken will do a video where he'll answer everyone's questions, and you guys can all watch. And so we're definitely trying to make sure our communication stays up. I know it's been a little while since a video, but we'll try to do one in a few weeks and stay in touch with everybody.
Absolutely.
Okay.
So you all take care of yourselves and try to enjoy the nice weather. Well, by the way, if any of you are snow skiers, go ski in the California mountains, amazing snow. Anyway, take care, everybody. Bye-bye.
Bye.